So for the first time in my life, the Wall Street Journal agrees with me. The $500 billion valuation that OpenAI put on its employee sale of shares in a secondary transaction is bad for the investors, and it's even worse for the market. Let's get into it. A couple of weeks ago, I published an episode talking about investor liquidity as it relates to consolidation in the private markets. If that sounds incredibly boring to you, apologies. But effectively what I'm talking about is that fewer and fewer deals are getting more and more of private investment capital in venture capital. I used OpenAI as an example in their Q1 fundraise valued at $300 billion, and they raised, I think, $8.2 billion or something like that. But I use as an example of how big does a company become before liquidity starts to become an issue. And what I was alluding to was if you are too valuable as a startup, where do you go from there? Because the merger and acquisition route is probably not available to you if you're too expensive because you're too valuable. And the initial public offering or the public market exit is also not available to you because, again, you're too expensive, you're too valuable. Between publishing that episode and now, OpenAI has announced that it is going for a $500 billion valuation around secondary sales to their employees. And I think they're going to allow like $60 billion worth of early employees or former employees worth of shares to be sold on the secondary market. Again, very quickly, secondary market, secondary sale just means that one investor or one shareholder is selling to an investor or someone else who wants those shares. It's just not tied to a public financing event. It's not tied to public markets like an IPO or any traditional kind of financing rounds, A, B, C, D, E, F, G, whatever the case may be. This is just separate from that, so secondary transaction. Here's what's interesting about that. I published that episode, and then literally yesterday, today is the 21st, yesterday was the 20th of August, the Wall Street Journal comes out with an article that says startup valuations blast beyond historic IPO market caps, which, funny enough, last week I did a follow-up episode, real quick one like this one, talking about how the secondary sale was happening at OpenAI and at a $500 billion valuation. I'm not sure where they go from here. And the Wall Street Journal apparently now agrees with me, or agrees with me in the larger sense, which is these startups become so valuable, you can't go IPO, you can't do an initial public offering because it is so far beyond what a traditional market cap or public market valuation would be. There's no translating it. So how does OpenAI, even now, a year from now, 2 years from now, try and go public at a $500 billion to $1 trillion valuation? The public markets have never done that. They haven't accepted that level of valuation, as certainly not at those multiples on revenue, which, you know, for OpenAI at one point in time was at least 30 times their run rate of revenue, not even their actual revenue, but their run rate of revenue. The public markets don't love that, right? And so they're not going to be super interested in buying a share price that represents, or buying in at a share price that represents a $500 billion or $1 trillion valuation. It's just going to break the model of public markets. I'm all for evolution. I'm all for paradigm shifts. Maybe this is the thing that completely changes, you know, hundreds of years of history of how this stuff works in the public markets. And if so, fair enough. But the Wall Street Journal is now picking up on this. Same thing that I just talked about last week, which is that these valuations are so expensive, it's going to be very difficult for them to go public. And why that matters is here we go again with the liquidity issue for those investors that are shareholders in companies like OpenAI with these monster valuations. How do they make money? How do they get a return on their investment if their only option is in the secondary markets or doing these secondary sales. That's not overall healthy for venture capital. It's certainly not healthy for those investors that are kind of stuck with this investment and no way to have a liquidity and potentially not have a path to liquidity, at least through the public markets. Now, could a private company come and buy or merge, quote unquote? There's never a merge. There's always a buyer and a seller. But let's just play the game. A merger and acquisition type opportunity for OpenAI? Sure. Who has the cash or who has the relative value in their own shares to acquire a company that has $1 trillion valuation? Well, the answer is very few, if any. Some of the most valuable companies in the world are $2 trillion, $3 trillion market caps, and that's pretty rare air for any company, and there's only a handful of those. So saying all that, it reminded me that BlackRock just announced recently they have amassed a mega fund around only secondary transactions. First, they predict that there will be basically $4 trillion in a private equity secondary market in transaction value, not even the market value, the transaction value by 2030, which is a doubling of where it is right now. Let that sink in for a second. They're talking about $4 trillion in private equity secondary market transactions by 2030, which doubles what it is right now. So have we crossed a threshold where private markets are going to rely on secondary markets, secondary transactions for liquidity because these companies have now surpassed anything that the public market is going to have appetite for? Surpassed thresholds that any private company could do any kind of meaningful merger or acquisition of OpenAI. And it's not just OpenAI. I mean, SpaceX has probably crossed this threshold. Anthropic is probably about to cross that threshold. So here we are. What I talked about a couple of weeks ago in that episode is bearing itself out or showing itself to be true, at least in recent news, where even the Wall Street Journal is saying, how do these companies go public? And if they can't go public, where does that liquidity come from? And if that liquidity can't come from traditional methods or traditional outcomes that create liquidity for investors, are we just talking about a world of private equity that is run through funds like Blackstone's, where it's just we're buying and trading secondary shares or shares on a secondary market to create liquidity or pass liquidity around. And then ultimately, how does that work out, right? So now you've bought somebody else's position, then you resell it and you hope it's worth more, and there's no public market for it. So this is all very strange, but this does harken back to this consolidation is creating illiquidity at a massive scale I don't think we've ever seen before. And if this continues, we may see the rise of the secondary market as being the liquidity mechanism for private investors. So where do we go from here? Maybe I'm wrong. Maybe the Wall Street Journal and I are just thinking about this in too myopic a term. Maybe this does completely transform the public markets and we start seeing IPOs with valuations of $500 billion or $750 billion, or even $1 trillion. I just don't think that's likely. I think we are now seeing the dawn of the secondary market taking over as the primary liquidity mechanism for private investors. And I think that market is too small and it's unsustainable. And ultimately, I think it's unhealthy for the market.